Good afternoon, everyone, and welcome to our third quarter review. This is Bruce Connors on behalf of BlueKey and Envision Asset Management. So here's a look at the first 6 months of the year, and it's been a really good year so far. The S&P 500 is up 8.25%, and with dividends, it's up 9%. After the election, you had the big rally which ran to like mid-December, and the market kind of flattened out through the inauguration. At the inauguration time, there was some talk that the market would fall off after that point, but that's not what happened. Actually, the opposite happened, and the market had a pretty good rally going into March, in which time it started falling off just a little bit, but basically remained flat as optimism began to dwindle about the Trump agenda and reality began to set in that his pro-business proposals may not happen so fast. After that, the market started to rally again in mid-May, flattened out over the last couple of weeks, but just, and this chart's from about a week ago, but just yesterday again, it broke out to new highs. This week, when Yellen had testimony beginning on Wednesday, indicating that she would be really slow in terms of increasing interest rates, the market liked that and hit new highs just yesterday. Here are the style box returns, and in the upper left you see the first 6 months. You'll see that growth has been the leader this year. That's the opposite of last year when value was the winner. Looking at sectors, technology and healthcare, both over 15% year to date. Telecom and energy taking up the back end, minus 13% and minus 14%. International equities have been strong this year. Developed markets up about 15%, Europe plus 17%, and emerging markets around 15%. Looking at fixed income sectors, emerging market debt have been the winners so far, local currencies plus 10%, and US denominated emerging market debt plus 6%. If you look at the aggregate, plus 2.3%. Looking at commodities, just some of the ones that we're interested in. Gold down just a little bit, and all the energy commodities are down. Heating oil, natural gas, crude oil. The different factors such as momentum, cyclical, quality, min-vol, etc. Momentum plus 18%. And that, of course, ties into the whole growth sector. They often go hand in hand. So momentum has been the big winner. You notice last year they were in last place. This year in first place. Here's a look at the different asset classes and emerging market equity. This is from JP Morgan. They're plus 18.6%, developed markets plus 14.2%. So overseas has been the leading area to invest in terms of asset classes this year. Let's look at some of the economic indicators, try and figure out where the economy is going. This is the leading index, and it's followed by the Philadelphia Fed. And you'll notice that for a long time, really since 2011, we've been in this range. And that's why the economy continues to be in that 1.5% to 2% growth mode. Hasn't broken out to the upside or the downside. And from all indications, that appears to be the way the economy is going to continue to travel along in the near term. This is a measurement of a probability of a recession over the next 12 months by the New York Fed. They look at the 10-year note and a 3-month bill, the difference between it, and they're projecting the probability of a recession over the next 12 months at about 10%. That's up from 5% in April. Investors get concerned, as well as economists, when the yield curve begins to flatten and then inverts. An inverted yield curve often is a very good predictor of a recession. So in this chart, we're comparing the yield curve on July 7th of 2017 versus the yield curve a year earlier. Pretty much the same shape. It's actually steepened by about 17 basis points. If we put up the chart from 12/30 of 2016, it would have flattened by about 26 basis points. Most of this year, the yield curve has been flattening, but over the last couple of weeks, it began to steepen a little bit. But as of now, it's not inverted. So based on this indicator, there's no sign of a recession, at least in the near term. Looking at jobless claims, this really continues to be the strongest part of the economy and has been for a while. Initial jobless claims are generally coming in around 250,000 or so for several months now, and those are very, very low numbers. As a matter of fact, the last time we had numbers that low were dating back to the early 1970s. So if this chart here now, we're looking at a percentage change, not absolute numbers. You'll notice how it's been pretty much flat for a long time now. So the job market continues to be tight, and again indicating that the economy is in somewhat decent shape, although it continues to grow at a slow rate. But it doesn't appear to be at risk, at least right now, of falling off a ledge. Here's the Atlanta Fed's GDP now. They're predicting growth rates here for the GDP in Q2 coming in at 2.4% as of yesterday. You'll see it's tailed off throughout the quarter, but still 2.4% is higher than the 1.4% growth we had in Q1. And here's the New York Fed nowcast. Again, this is their estimate of Q2 growth. This is as of July 7th. They're at 1.96%. And an early look at Q3, they're forecasting a little bit slower growth than Q2, about 1.8%. This BlackRock model anticipates what growth will be in about 3 months. They're looking at north of 2.5%, which would be pretty strong compared to the other estimates. The International Monetary Fund updated their estimates for U.S. growth going out a few years. And again, you'll see between 1.5% to 2% or so over the next few years, according to the IMF. Here's a BlackRock model of the G7 countries, and you'll see how growth estimates have been improving over the last year. And that's really been one of the bright spots. You'll see in a couple minutes that other charts we're going to look at. The entire economies around the world have really been pretty solid. And in this PMI chart, that stands for Purchasing Managers Index, looking at a global composite, you'll see all the numbers are north of 50 for May of 2017. So when you're above 50, that indicates expansion. Less than 50 is contractionary. And if you look in the far right column, that compares May of 2017 to May of 2016. Every single country or region has a higher number than a year ago. And here it is broken down by individual countries, and you'll see nobody is in the red. Every country except for Indonesia has a number that's higher than 50. And if you look back at March of 2017 at our last webinar, there were 3 countries less than 50. December of 2016 there were 5. So clearly there is better growth. This is a sentiment indicator by Centex. It looks at investors' perceptions of different economies around the world, and most of the economies are in boom mode. What's interesting is the USA popped up on this most recent survey as cooling, indicating a slowing down of growth. So we'll have to keep an eye on that. So what are the risks going forward? I think the main risk is still the wild card of Trump, and we spoke about that back in the January webinar. He's still, as we all know, Trump could do anything on any given day, and there's real risk with that, I think, in terms of trade. When he was campaigning, he was talking about huge tariffs on Mexico and China. He was smart enough, or at least his advisors were smart enough, to get him to back off that, but there's still talk that he may cancel NAFTA at any moment. There's always the threat of a trade war with China. He's talking about steel tariffs. So I think that's a threat to the economy. There's lots of geopolitical risk out there, and the market seems to be ignoring that. You have the big issue with North Korea, there's Syria, Russia, etc. Market volatility has been ridiculously low, and at some point that's going to break out. Although, if you look at history, there have been extended periods of low volatility. So it's possible we're in one of those periods now, and that might continue. We're going to talk about oil and the Fed in a few minutes. There's always the risk of China, although the economy continues to grow in the 5 to 6%, 7% range in China. Let's look at crude oil. Crude was at about $53 or so on April 12th when we did the last webinar. It's fallen off since then, got down as low as 43, now back to about 45. The risk is if the price of oil basically falls off a ledge, which could impact the debt markets. Another possible problem is, what if oil stays in this range, around $45 to $50, just enough for a lot of these producers to make just a little bit of money, to operate on super flat margins. And with all the credit availability, one thing they may do to try and increase their return on equity is to lever up. So if prices remain flat and fixed income lenders think it's a good idea to lend to some of these energy producers who are looking to increase their returns, and then what at that future point if oil drops suddenly? Well, then you'd be in a situation kind of where we were at the beginning of 2016, where it almost led to, a high yield scare. This chart looks at the change in the level of inventories, and you'll notice that in the red circle that inventories have actually been going down over the last few months, but at the same time the number of rigs trying to produce more oil has been going up. So the net effect, or the estimate, is going to be that inventory is going to be down a little bit in 2017, and then it'll inch up again in 2018. But what would be ideal is that if oil prices can go up a little bit, maybe into the mid-50s, that seems to be a good median area that would help the producers and at the same time keep the economy in good shape. The Fed increased rates in June to a target rate of between 1 and 1/4%. They're talking about one more increase in 2017 and then 3 increases in 2018. Perhaps what is more important is that the Fed wants to begin unwinding their huge balance sheet sometimes towards the end of this year. This is something that has never been done in the entire history of the Fed, at least not to the level that we're talking about. And so no one really knows how the market's going to react to that, but they've come out with a plan that's very moderate and deliberate, and they want to keep the market informed as to what's going on. Hopefully it won't have that much of a negative impact, but I think the main theme to know is that interest rates still are way too low. They're definitely below what the market thinks they should be at, and the Fed has to put themselves in a position where interest rates can slowly get back to a normal level. Right now it's kind of like driving down a highway without a spare tire. The Fed has no ammunition should we go into a recession, and interest rates are just abnormally low, which changes the proper allocation of money. So they need to slowly put interest rates back on the path towards normalization, and that appears to be what they're going to try and do. So we'll have to see what the impact on the markets are going to be. And one of the key things is going to be, can earnings increase enough to offset the increases in interest rates? This looks at the 10-year Treasury, and you'll see on July 6th of 2016, down on the bottom right-hand corner, we hit an all-time low of 1.37% on the 10-year Treasury. Coincidentally, we had just done our webinar like a week or so after that. We said at the time we thought that might be the all-time low, and so far at least that's turned out to be correct. About a year later, we're up almost 1%. So we think that slowly over time interest rates will continue to drift higher. Now, what is the risk of that? This chart, which is from our October 2016 presentation, here you're looking at slow cycles of interest rate increases, and that's usually like 1 or 2 a year. And you'll see when that happens, it really does not impact the market. And that's been the case really over the last year or so. We only had 2 increases, one in December, one in June. But what happens in a fast cycle? Fast cycles would be like 3 or 4 increases during the year. And when that happens, the market is pretty much flat. Let's look at price to earnings ratios. And the S&P 500 forward PE is 17.4. If you look at the red line, that's the S&P 500. So that's about 17.4. The 5-year average is 15.3, and the 10-year average is 14. So we're pretty comfortably above those numbers. So the market is definitely fully valued. Some would say it's overvalued. And the purple line would represent the 5-year average, and the blue line the 10-year average. In this chart, and this is from JP Morgan, here they're looking at the 25-year average, which is higher, 16. So they measure, as of June 30th, the forward PE at 17.5. It's less than 1 standard deviation higher. So here, if you go back 25 years, you're not that much overvalued. If you look at the Shiller PE, and I'm in the chart in the upper right, it's at 30.1. The 25-year average is 26. Dividend yield is about in line. Price to book is exactly the same. Price to cash flow a little bit higher, but the earnings yield minus the BAA yield, that would be an investment grade bond. This is something that I think makes it where you can justify a higher value for the market. Basically what's that saying is you take the inverse of the price to earnings ratio, and you take the earnings divided by price. That's what's called the earnings yield. And in this case, the earnings yield of owning a share of a company is greater than owning a bond. So that would be a big incentive on why you want to continue to own equities, and on why pricing in equities is not wildly overvalued. My personal opinion is that we're pretty much in a fully valued state, but not wildly overvalued. Now, one of the reasons the market has rallied this year is that corporate profits have really improved. We went through an earnings recession. You look back from the second quarter of 2015 to the second quarter of 2016, earnings were down year over year, all those quarters in a row. And in the first quarter of this year, we really broke out, plus 14%. And as of June 30th, analysts were projecting a 6.6 increase for the most recent quarter. Now, normally earnings come in a little bit higher than the end of quarter estimate. The average has been about 2.9%. So if that happens this quarter, we'll see an earnings increase of 9.5%, which again would be really, really strong. So far through July 14th, 6% of companies have reported earnings, and the aggregate increase has been 8.2%. So it looks like we're going to have another really solid quarter of earnings, and that has helped keep price earnings ratios up and keep the market moving ahead. Going out, looking at 2017, the entire year, analysts are estimating earnings of 130-160. That would be up 10% from last year. And 2018, again, plus 11%. Now, those estimates usually come down over time, but the point is analysts are expecting decent earnings growth ahead. Now, should that happen, that would, help justify the ratios that we have right now and the valuations we have right now. This gets back, this chart, to what I was talking about a couple of minutes ago with the earnings yield. And here you're looking at the Moody's BAA minus the S&P 500 forward earnings operating yield. And again, it's in a favorable territory. Let's look around the globe. And this chart here measures price to book ratio. And the blue square box would be the 15-year average of the price to book, and the diamond would represent the current price to book value. So if you look at the S&P 500 off to the left, significantly higher than the 15-year average. If you go off to the right, you'll see better valuations overseas. So the IFA index, it's about at par. Same with Japan. Emerging markets, though, the current valuation is actually less than the 15-year average. So based on price to book, there are better valuations overseas right now. This chart from Morningstar compares the value of the price of the median stock in the Morningstar universe of stocks that they rate compared to the fair value. So it's the price divided by the fair value, so it's overvalued by 3%. If you see, that's kind of in line of what the value has been since 2012. So again, the market's not wildly overvalued, but it's definitely fully valued and a little bit overvalued by this chart. Here's our corrections chart. We keep track of pullbacks of 5% or greater. This dates back to 2005. We are now over 1 year since the last pullback of 5% or more. So we're way overdue for some kind of correction or pullback. It's been 383 days since the last correction. And this has only happened 6 times since 1950, where the S&P 500 has gone 12 months or more without a 5% drop. And this is the longest such streak since 1995. Trying to figure out what the return in equity markets is going to be in the future is, of course, always a guess, and nobody knows. But there are 3 key variables: the dividend yield, the growth rate, and the PE ratio. So the dividend yield is around 2%. Let's assume that remains somewhat stable. Growth rate over the last couple of quarters has been really high, but that will probably fall back to somewhere in the 5% range or so. So dividend yield plus growth rate, figure you're at 7%. That leaves the PE ratio. Now, with the Fed increasing interest rates and probably on a path to normalization, there'll be a natural inclination for the PE ratio to decline. So depending upon how fast interest rates increase and how quick earnings grow, that'll have a lot to do with where the PE ratio grows. And that's really going to be the variable factor that determines where equity returns are going to go in the future. But if I had to guess, and it is only a guess, I would say that equity returns would be more subdued over the next 5 years than they have been over the last couple of years, maybe in the 5% or so range. But of course, there have been other periods where markets have been fully valued like they are now, and then they continued to have a really good run. So only time will tell. So what happens to the markets from here over the short run? Here are some reasons why the market will go down. First of all, we're just due for a correction, or at least a pullback of 5% or more. We haven't had one in over a year. The risk of what I call the bad Trump, his protectionist tendencies. He gets into a trade war with China. He's talking about major steel subsidies. What's the impact of all that? The geopolitical risk, I think this is a huge risk with what's going on in North Korea. You have Syria, Russia, the entire Middle East. Federal Reserve on a path to normalization. They're going to start unwinding their balance sheet. They have to be careful not to overplay their hand. We spoke about valuation, that markets might be fully valued right now. Reasons why the market will continue to go up. Well, first of all, there's just a lot of market momentum. This market does not seem to want to go down. You have the good Trump. What happens if we do get meaningful tax reform, or if repatriation is enacted, or if we continue to have good deregulation? Those are the kind of things that will help the market. The global economy really appears strong, at least in terms of recent times. You have growth around the world, as we showed with all the PMI numbers, and the U.S. economy continues in the 1.5% to 2.5% growth range, which has been going on now for a few years. But the point is, it's continuing to grow. There does not appear to be a near-term risk of recession. The job market is solid. So those are reasons why the market will go up. So at this time, we would have to give a very slight edge to the market continuing to be stable to slightly up. The main thing, though, is you want to have a plan. You want to invest for the future. You have to look at your timeline and your risk tolerance, and always keep in mind, the big picture, that over time, equities have been a good place to invest. So keep us in mind. If you have any questions or comments, feel free to contact any of us. We do comprehensive financial planning here. We try to stay on top of the markets and put together, good, diversified, solid portfolios. Also, please read our weekly newsletter. News changes quickly, and any of the things that we spoke about here today could really change on a moment's notice. So we try and keep everyone up to date in our weekly report. Thank you very much. Again, contact us with any questions. Good luck investing down the road.